Welcome to the long-term liabilities video. This is going to be a continuation of the last one. We're going to use the same examples we had, so I'm not going to recalculate how to calculate the bonds. The difference is on this one, our physical year is different than when we sold the bonds. Our bonds are going to be March 1st and April 1st is September 1st is when we're paying interest. However, our physical year, our calendar year is our company year. So we're going to go through it, how you do the entries. The calculations are done the exact same thing. You use the dates that you're actually paying the interest out on. Don't worry about your company year yet. And what we'll have then, so the calculations are the same way we did before. This is the 10% stated rate, 8% market, so we have a premium. So over here on March 1st, there's no adjustment we make. That is our carrying value, is what we received cash for. And this is the premium that we have, and the bonds payable is still for the 100,000. No worry about that. September, okay, that's our first payment. Interest expense is the 43.24.44. The premium amortized is 675.56, and the cash paid out will be for the 5,000. No biggie. Now here's where we have the adjustment, because our year ends December 31st. Okay, so the interest expense, we'll go to the interest expense, we'll click on the March 31st one, but we need September's last time we paid, so we have September, October, November, and December. So we take this number times 46, or 28.64.94. For the premium, we do the same thing. We go to the first one in 18, and we take that times 46, and that gives you 468.39. And then the interest payable is not cash, so we go to the 5,000 times 4 divided by 6, or 33,333. Okay, and so that's how we record it. And so that's interest payable. And then I don't have it, but in 12 and 3/1 of 18, okay, we have interest expense. Well, actually, what you can do is just I'll just copy and paste. The difference would be we have premium on bonds payable, and we'll have interest payable, because this was recorded last year. And then down here we would have cash, and interest payable is a debit, and cash is my credit. Okay, now interest expense would be for the March 1st minus what we recorded last year. The premium would be the same thing, March 1st minus what we already have recorded, because what you want is the difference. Interest payable would be the 333, and the cash account should be the 5,000. Okay, and that equals 5,000. Okay, so that's how you would record. That's how you would finish that one up for the. Okay, now the next topic we have, that's for the physical year, is different than the bond year is different than the physical year. Okay, next one we have is for early retirement. This is also the same example we had before. This is the 10% stated rate, 12% market rate. We do the chart the same way. Nothing's changed. We went back to our standard. These entries, the 92,000 is what you paid. Interest expense is this column here. Okay. And okay, so what we have, these bonds were callable. Callable means the company has the right to call them in at 102 plus accrued interest. So on March 1st of 2020, the company called the bonds in. We'll just call it all in. Okay, so the first thing you need to do is bring up the interest. You bring it up to date. Okay, because this is between interest payments for 2020. So the last one we used was this right here, and I'm going to highlight it so that you know that one we've done. Okay, so what we look at, interest expense, we look at the and it's March 31st, so it's 3 months into it. So the interest expense will be that cell there, because it goes to the next one, times 3 divided by 6, because that represents 6 months worth of interest. Okay, so that's 2896.05. The discount will be this amount here times 3 divided by 6. So it's 3605, and the interest payable is the 5,000 times 0.5 or 36 or 2,500, because we have to bring this up to date. Now we come down here to the calculate. Hopefully, because anytime you sell it, you bring it up to date. That's why I just highlighted that one so you can see where we was at. The call price, okay, that is equal to the 100,000. Times 1.02, because that's a percentage, so it's 102,000. The face value, we're retiring all of them in this case, so that's the 100,000. Then unamortized discount is this cell minus what we amortized, so that's the 3,069.02. And then the carrying value then would be equal to the 100,000 minus, is it discount, right? Yeah. Oops, try that again. Equal 100,000 minus this one. So it's 96,000. Yeah, something. 930.02. So the loss on the redemption is the 102 minus the 96, which is the carrying value, or we're losing $5,069.02. So what we have on this, bonds payable is for the entire 100,000. So that's the 100,000. Interest payable is the 2,500. We've got to pay that. The loss on the redemption is the 5,069.02. Discount on bonds payable is 3,069.02, and then the cash amount is equal to the 100,000 times the 1.02 plus the 2,500. So it's a total of 107,569.02. If we add these up, that gives you 107,569.02. So that's the retirement of bonds. The early retirement of bonds is how you do that. Okay, like I said, I highlighted this because that's the last entry that we did. So we look at the next one and take half of it. Okay, except for the discount, we have to take the 3465.07 minus the amount we've amortized, which was half of this 392. Okay, and that's how you do that, and that's how you determine whether you have a loss or a gain on the bond redemption. Now you might ask, why would they do that if they're losing $5,000? Well, keep in mind, we are no longer paying $5,000 worth of interest, so it's so we're saving ourselves $20,000 worth of interest, and we're losing $5,000. So you know it's pain, and that's why we do that. So actually, we lose $17,500 is what we're saving. So we save about $12,000 by paying it off early, because we no longer have the interest to pay on these bonds. And that's why the company would do that, is you would still save in the long run. All right, so that's early retirement, and the next video will be on warrants and conversion.